I'm going to lecture on accounting changes, and this will be covered in chapters 8 and 9. Actually, this is one of the topics that we have to discuss still on the third week, and we are still on the third week. So, for the basic objectives, uh, for accounting changes, including change in accounting estimate in chapter 8. So, to identify the categories of accounting change, to understand the concept of a change in accounting estimate, to identify the recognition and reporting of change in accounting estimate. So this is in chapter 8. Then in chapter 9, we have the accounting changes also, which involves change in accounting policy and prior period errors. So for the objectives, to understand the concept of a change in accounting policy, to know the recognition and reporting of a change in accounting policy, to determine the guideline when selecting accounting policy in the absence of an accounting standard, to understand the concept of prior period errors, and to identify the recognition and reporting of prior period errors. So far, these are the objectives that we have to uh, reach, no, or to achieve in connection with the study of chapter 8, the accounting changes. So we have now for the accounting changes in chapter 8. We have involved change in accounting estimate. So for the accounting changes, we have the categories of accounting changes. We have change in accounting estimate and change in accounting policy. So accounting changes can have a great impact on an entity's reported earnings. Change in accounting estimate. PS 8 paragraph 5 defines a change in accounting estimate as an adjustment of the carrying amount of an asset or a liability, or the amount of the periodic consumption of an asset that results from the assessment of the present status and expected future benefit and obligation associated with the asset and liability. Simply stated, a change in accounting estimate is a normal recurring correction or adjustment of an asset or liability, which actually the asset or liability is the natural result of the use of an estimate. The use of reasonable estimate is an essential part or of the preparation of financial statements and does not undermine their reliability. An estimate may need revision if changes occur regarding the circumstances on which the estimate was based, or as a result of new information, more experiences, or subsequent development. By very nature, the revision of the estimate does not relate to prior periods and is not a correction of an error. A change in measurement basis is a change in accounting policy and not a change in accounting estimate. Sometimes it's difficult to distinguish a change in accounting estimate and a change in accounting policy. In such a case, the change is treated as a change in accounting estimate with appropriate disclosure. So, to the extent that it's difficult to determine what type of change is involved, no, in the process. So normally it's more of change in accounting estimate. Okay, so we have now the examples of accounting estimate as a result of the uncertainties in business activities. Many items in financial statements cannot be measured with precision but can only be estimated. Estimation involves judgment based on the latest available and reliable information. Estimates may be required for the following: doubtful accounts, inventory obsolescence, useful life, residual value, and expected pattern of consumption, benefit of depreciable asset, warranty cost, and fair value of financial assets and financial liabilities. How to report an accounting estimate? The effect of a change in accounting estimate shall be recognized currently and prospectively by including it in income or loss of the period of change if the change affects that period only, and the period of change and future periods if the change affects both. To the extent that the change in accounting estimate gives rise to changes in assets and liabilities or relates to item of equity, it shall be recognized by adjusting the carrying amount of the related asset, liability, or equity in the period of change. Accounting changes, change in accounting policy, and prior period errors. Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Accounting policies are essential for a proper understanding of the information contained in the financial statements. An entity is required to outline all significant accounting policies applied in preparing financial statements. Under accounting standards, alternative treatments are possible. In this case, it becomes all the more important of an entity to clearly state the accounting policies used in preparing financial statements. The entity shall select and apply the same accounting policies each period in order to achieve comparability of financial statements or to identify trends in the financial position, performance, and cash flows of the entity. Once selected, accounting policies must be applied consistently for similar transactions and events. A change in accounting policy shall be made only when required by an accounting standard or an interpretation of the standard. The change will result in more relevant and faithfully represented information about the financial position, financial performance, and cash flows of the entity. Examples of change in accounting policy. A change in accounting policy arises when an entity adopts a generally accepted accounting principle which is different from the one previously used by the entity. And we have the following examples. Change in the method of inventory pricing from the FIFO to the weighted average method. So in cost accounting, we involve the use of the FIFO method, and we have the weighted average method. Change in the method of accounting for long-term construction contracts from cost recovery method to percentage of completion method. C. The initial adoption of policy to carry assets at revalued amounts is a change in accounting policy to be dealt with as revaluation in accordance with PES 16. Change from cost model to fair value model in measuring investment property. Change to a new policy resulting from the requirement of a new PFRS. How to report a change in accounting policy. A change in accounting policy required by standard or an interpretation shall be applied in accordance with the transitional provisions therein. If the standard or interpretation contains no transitional provisions, or if an accounting policy is changed voluntarily, the change shall be applied retrospectively or retroactively. So it's either retrospectively or retroactively. Change in reporting entity is a change whereby entities change their nature and report their operations in such a way that the financial statements are in effect those a different reporting entity. For example, this accounting change may result from changing the specific subsidiaries comprising the group of entities for which consolidated financial statements are presented. A change in reporting entity is actually a change in accounting policy and therefore shall be treated retrospectively or retroactively to disclose what the statements would have looked like if the currently entity had been in existence in the prior year. In other words, the financial statements of all prior periods presented shall be restated to show financial information for the new reporting entity. Absence of accounting standard, PES 8, paragraph 10, provides that in the absence of an accounting standard that specifically applies to a transaction or event, management shall use judgment in selecting and applying an accounting policy that results in information that is relevant to the economic decision-making needs of users and faithfully represented. Paragraphs 11 and 12 specify the following hierarchy of guardians. So we have the following hierarchy of guidance which management may use when selecting accounting policies in such circumstances. Letter A. Requirements of current standards dealing with similar matters. B. Definition, recognition criteria, and measurement concepts for assets, liabilities, income, and expenses in the conceptual framework for financial reporting. Most recent pronouncements of other standard-setting bodies that use a similar conceptual framework, other accounting literature, and accepted industry practices. So we are through with accounting changes, change in accounting estimate, accounting policy, and reporting entity. Next, we have the prior period errors, are omissions and misstatements in the financial statements for one or more periods arising from a failure to use or misuse reliable information that was available when financial statements for those periods were authorized for issue and could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. Errors may occur as a result of mathematical mistakes, mistakes in applying accounting policies, misinterpretation of facts, fraud, or oversight. How to treat prior period errors. Prior period errors shall be corrected retrospectively by adjusting the opening balances of retained earnings and affected assets and liabilities. If comparative statements are presented, the financial statements of the prior period shall be restated so as to reflect the retroactive application of the prior period errors as a retrospective restatement. Retrospective restatement means correcting the recognition, measurement, and disclosure of amounts of elements of financial statements as if a prior period error had never occurred. In other words, net income, its components, retained earnings, and other affected balances for the prior period represented shall be adjusted accordingly. If the error occurred before the earliest prior period presented, the opening balances of assets, liabilities, and equity for the earliest prior period presented shall be restated. When it is impracticable to determine the cumulative effect at the beginning of the current period of an error on all prior periods, the entity shall restate the comparative information to correct the error prospectively from the earliest date practicable. Now, disclosure of prior period errors. An entity shall disclose the following: the nature of the prior period error, the amount of correction for each prior period presented to the extent practicable, for each financial statement line item affected, for basic and diluted earnings per share, the amount of correction at the beginning of the earliest prior period presented, if retrospective restatement is impracticable for a particular prior period, the circumstances that led to the existence of that condition, and a description of how and from when the error has been corrected. Okay, so we have now your uh, the end of the PowerPoint presentation. But anyway, you may also read your books for whatever uh, items that were discussed in the PowerPoint. Now let's go to the problems. First, we have the problems of Chapter 8. Chapter 8 now has only a few problems, just like the other chapters. So we have this time, we have 15, including the multiple choice problem starting from 8-13. So 8-1
Rao sa may siyo.
okay. So we now go to the problems in chapter 8, beginning with 8-1. What is the depreciation of the machine for 2020. Blue Company purchased a machine on January 1, 2017 for 6 million. At the date of acquisition, the machine had a life of 6 years with no residual value and was depreciated on a straight line basis. So that was beginning January 1, 2017. On January 1, 2020, the entity determined that the machine had useful life of 8 years from the date of acquisition. So it's not only 6 years as estimated on January 1, 2017, but it's for a period of 8 years, but no residual value. So what is the depreciation of the machine for 2020? So we have now on January 1, 2017 the cost of 6 million. If we divide 6 million by 6 years, that would be 1 million a year. So from January 1, 2017 to January 1, 2020, it's for 3 years multiplied by 1 million. So the accumulated depreciation for 3 years is 3 million, leaving a carrying amount on January 1, 2020 of 3 million. Now, for the depreciation for 2020, actually, we now begin with the remaining life of 5 years. That's counting 8 years minus the recorded expired life of 3 years. But the remaining life is not only 3 but 5 years. So we now divide 3 million by 5 years, leaving the annual depreciation from 2020 equal to 600,000. So the requirement is what is the depreciation for this machine on in 2020. So the amount is 600,000 in letter B. 8-2 Acute Company was incorporated on January 1, 2017. In preparing the financial statements for the year ended December 31, 2019, the entity used the following original cost and useful life for the property, plant, and equipment. So that was on December 31, 2019. Building, machinery, and furniture with their original cost and the useful lives. Now, January 1, 2020, the entity determined that the remaining useful life is 10 years for the building, 7 years for the machinery, and 5 years for the furniture. Now, from January 1, 2017 to January 1, 2020 is a period of 3 years. But we have this remaining useful lives after 3 years. So useful life of the building initially was 15 years, and the remaining useful life by January 1, 2020 is only 10 years. So meaning it reduces the life of the building, and it's not 15 years because on January 1, 2020, after 3 years, the remaining life is only 10 years. Then the machinery original life was 10 years. After 3 years is still 7 years. And for the furniture, the life initially was 7 years. After 3 years, it's still 5 years. The entity used straight line method of depreciation with no residual value. What is the total depreciation for 2020? So we now have the cost and the accumulated depreciation only up to December 31, 2019. So a total of 3 years. Now we divide for the building 15 million divided by the useful life of 15. Then we have a period of 3 years expired. So the accumulated depreciation on the building is 3 million. On the machinery, the original life is 10 years. So annually, it will be 1,050,000 times 3 years. And for the furniture, the original life is 7 years. So dividing the original cost by 7, that gives 500,000 a year times 3 is 1,500,000. So the carrying amounts on January 1, 2020 for the building 12 million, machinery of 7,350,000, and the furniture of 2 million. Now these are the carrying amounts on January 1, 2020. And the depreciation for 2020, we now divide the carrying value of the building is 12 million divided by the remaining life given of 10 years. For machinery, it's only 7 years, and for the furniture, 5 years. So we now have the depreciation expense total for 2020 of 2,650,000. Now that is letter A for requirement or for problem 2. Then we go to problem 3. We have the requirement of problem 3 is to determine the accumulated depreciation for on December 31, 2020. On January 1, 2017, Flair Company purchased a machine for 2,640,000 and depreciated it by the straight line method using an estimated life of 8 years with no residual value. On January 1, 2020, the entity determined that the machine had useful life of 6 years from the date of acquisition with residual value of 240,000. Now we determine the accumulated depreciation on December 31, 2020. So we now begin with the original cost of 2,640,000 and dividing it by 8 years, the original estimated life, and from January 1, 2017 to January 1, 2020, it's a period of 3 years. So we now have the accumulated depreciation equal to 330,000 a year times 3 years or 990,000. So the carrying amount is 1,650,000 on January 1, 2020 when there was a change in the estimated life. So the accumulated depreciation on January 1, 2020 of 990,000 and the depreciation for 2020 is 1,650,000. We now deduct 240,000, that's the residual value, and we divide it only by 3 years. From the date of acquisition, the revised estimated life is only 6 years, and we deduct the expired life of 3 years as of January 1, 2020. So that gives the annual depreciation as revised equal to 470,000. So the total of the accumulated depreciation by December 31, 2020 is 1,460,000. That's the total. Then we go to problem 84. January 1, 2016, Roma Company purchased equipment for 4 million. The equipment has useful life of 10 years and residual value of 400,000. On January 1, 2020, the entity determined that useful life of the equipment was 12 years from the date of acquisition and the residual value was 480,000. What is the carrying amount of the equipment on January 1, 2022? Okay, what is the carrying amount of the equipment on January 1, 2022? So we now have the computations for 84. January 1, 2016, the cost of the equipment bought was 4 million, and then the accumulated depreciation after 4 years. On January 1, 2020, we have 4 million minus the residual value of 400,000. So we have 3,600,000 divided by 10 years, the original estimated life, and we multiply by 4 years, counting from January 1, 2016 to December 31, 2019. So it's a period of 4 years and the accumulated depreciation of 1,440,000. So the carrying amount on January 1, 2020 is 2,560,000. That's now in question number 1. What is the carrying amount of the equipment? So we have for January 1, 2020. Initially, the amount of the carrying amount on January 1, 2020 is 2,560,000. So what is the carrying amount of the equipment on January 1, 2020? That's correct, not 22. January 1, 2020. So the amount or the carrying amount is 2,560,000 before adjustment in the change in the estimated life. Now in question number 2, what is the depreciation of the equipment for 2020? So beginning January 1 up to December 31. If we have the remaining life, actually the life as change is now estimated at 12 years. So we have already recorded 4 years depreciation. So the remaining life is 8 years. So based on the carrying amount of 2,560,000, we have to deduct the residual value of 480,000. Then the depreciable amount is 2,080,000. And we divide it by a period of 8 years. The estimated life now was changed from 10 to 12 years. So 12 years minus the expired life of 4 years. So we still have 8 years. Annually, from 2020, the depreciation is 260,000. So we now have 260,000. That's now the depreciation of the equipment for 2020. The revised useful life is 12 years minus the expired life of 4 years. So we have the remaining useful life of 8 years. Now in problem 8.5, Dawn Company purchased a machine on January 1, 2017 for 3 million. At the date of acquisition, the machine had a life of 6 years with no residual value. The machine is being depreciated on a straight line basis. On January 1, 2020, the entity determined that the machine had a useful life of 5 years from the date of acquisition with residual value of 100,000. So what is the depreciation for 2020? The answer is letter A for 8, that's 5, so it's 700,000. Now, if you have the original cost of 3 million and we divided 3 million by 6 years, so the annual depreciation based on the original estimated life, 3 million divided by 6 years is 500,000 a year. Then the expired life from January 1, 2017 to December 31, 2019 is 3 years multiplied by 500,000, the annual depreciation. So the accumulated depreciation as of January 1, 2020 is 1.5 million, giving a carrying amount or book value of 3 million minus 1.5 million. So it's 1.5 million, and this time the change in the accounting estimate from the original life of 6 years, it's only 5 years, and we deduct the expired life of 3 years, the remaining life is only 2 years. Now 1.5 million is the carrying amount on January 1, 2020, 1.5 million, and we deduct the residual value of 100,000. The depreciable cost is 1.4 million divided by 2 years, so we have 700,000 a year. That's for problem 8.5. Then for 8.6, the depreciation for 2020 is the one being asked for. So we have now on January 1, 2018, Z Company purchased for 2.4 million a machine with useful life of 10 years and no residual value. So that means 2 million 400,000 divided by an original life of 10 years. So meaning 240,000 a year. The machine was depreciated by double declining balance method, and the carrying amount of the machine was 1,536,000 on December 31, 2019. That is after 2 years. The entity changed to the straight line method on January 1, 2020. So what is the depreciation for 2020? If we now have the carrying amount of 1,536,000 by December 31, 2019, so by 2020, we have to divide 1,536,000 by a period of 8 years. That's 10 years initial estimated life minus the expired life of 2 years, so the remaining life of 8 years. 1,536,000 divided by 8 years, so that gives 192,000. In 8-6, the answer is letter D. Then we go to 8-7. In 8-7, on January 1, 2019, Kevin Company purchased a machine for 2,750,000. The machine was depreciated using the sum of years digit method or the SYD method based on a useful life of 10 years with no residual value. January 1, 2020, the entity changed to the straight line method of depreciation. What is the depreciation for 2020? Now, the cost on January 1, 2019 was 2,750,000. Then we deduct the accumulated depreciation for 1 year. That's in 2019. So, by using the SYD method, then we have to add 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Add, that will be the numerator. Okay? So, or we use the formula. We have 10, that's number of years, plus 1. 1 is constant. And then we divide it by 2. Now, this is the formula. So, we have the estimated life plus 1 divided by 2. And you multiply it by 10. So, 11 divided by 2 is 5.5. And we have n of 10. So, the SYD is 55. That's the denominator. The numerator is 10 for the first year. Pag second year, 9 na lang. Pag third year, 8. So, in the year 1, we multiply 10 over 55 by 2,750,000. That gives 500,000. The accumulated depreciation by January 1, 2020, 500,000. So, the carrying amount by January 1, 2020 is 2,250,000. And since January 1, 2020, the equity changed to the straight line. So we now divide the carrying amount of 2,250,000. We divide it by 9 years remaining. That gives the depreciation expense for 2020 equal to 250,000. So 8-7 is letter C for 8-7. Then we go to 8-8. Okay, the problem is asking for the amount that should be reported as accumulated depreciation on December 31, 2020. Now, Turtle Company purchased equipment on January 1, 2018 for 5 million. The equipment had an estimated 5-year service life. The policy for 5-year assets is to use the 200% double declining balance method for the first 2 years and then switch to the straight line method. Now that is on the 3rd year. What amount should be reported as accumulated depreciation on December 31, 2020? So meaning we have to compute for accumulated depreciation, no? But for 2018, we compute the depreciation as well as in 2019. and we have to determine the depreciation for 2020 so as to report the accumulated depreciation as of December 31, 2020. So the 2018 depreciation is 5 million multiplied by 40%. That's double declining. If we now determine the percentage for 5-year assets, so dividing 100% by 5 years, that will give us 20% for the 5-year life. So 20% per year, and you multiply it by 2 or 200%. So meaning year 2018 we use 40%. So 40% of 5 million or 2 million. Then in 2019 we have the remainder of 3 million. That's 5 million minus 2 million. So we have the remainder of 3 million, and then we again multiply it by 40%. So we get 1.2 million, the accumulated depreciation by December 31, 2019 after 2 years. Then for 2020 being the third year, we now use the straight line method. So the 5 million original cost minus 3.2 million the accumulated depreciation. We have 1.8 million the remaining carrying amount, carrying value. So we have to divide it by 3. That's 5 years minus 2. So the remaining life of 3 years. So annually we get 600,000. 3.2 million the total accumulated depreciation for the first 2 years, and on the third year we have 600,000. So the accumulated depreciation on December 31, 2020 is 3.8 million. That's letter B. Next, we have 8-9. What's the depreciation for 2020? Xavier Company purchased machinery on January 1, 2017 for 7.2 million. The machinery has useful life of 10 years with no residual value and was depreciated using the straight line method. In 2020, a decision was made to change the depreciation method from straight line to sum of years digits. So that is 17, 18, 19, 3 years expired life. In 2020, the method of depreciation was changed from straight line to sum of years digits. The estimate of useful life and residual value remain unchanged. Okay, so we have the original cost of 7.2 million with no residual value. The accumulated depreciation from 2017 to 2019 for a period of 3 years is taken by dividing 7.2 million by 10 years. That's the original estimate of the life of the asset. So we now get 7.2 million divided by 10 years. And so we get 720,000 per year times 3 years expired life. So we have 2.160,000. The carrying amount on January 1, 2020 is 5,040,000. 5,040,000. Now, in 2020, the method of depreciation was changed to SYD. So, this involves a remaining life of 7 years. So, again, we have the formula, and the sum of years digits is 28. So, we use the formula. This time, we have 7 plus 1. So we have to divide by 2 times 7. So we have 28 as the SYD. Depreciation expense for 2020 is 5,040,000, and then we multiply it by 7 divided by 28, or 1/4. So that gives us 1,260,000, the depreciation for 2020. Next, we go to 8-10. What is the accumulated depreciation on December 31, 2020? January 1, 2018, Brasilia Company purchased for 4,800,000 a machine with useful life of 10 years and a residual value of 200,000. The machine was depreciated by the double declining balance method. The entity changed to the straight line on January 1, 2020, so meaning after 2 years, the residual value did not change. What is the accumulated depreciation on December 31, 2020? So we now have the accumulated depreciation by January 1, 2020, and of course we have to determine the accumulated the depreciation for 2020. So we have the residual value in 8-9. We are given the residual value of 200,000. Okay, we now go to 8-10. Accumulated depreciation on January 1, 2020 is 1,728,000, computed by using the double declining balance method. So we now have the original cost of 4,800,000, and we have the accumulated depreciation of 1,728,000, leaving a carrying amount of 3,072,000. Still, we deduct the residual value of 200,000. We deduct the residual value of 200,000. So the difference of 2,872,000, we divide it by 8 years. Based on the original life of 10 years, we deduct 2 years, so that leaves 8 years for the remaining life. So we have for 2020, the depreciation expense is 359,000. The accumulated depreciation by December 31, 2020, that's after 3 years, is 2,087,000. Next, we have problem 11. In problem 11, again, we have the requirements in here. What's the depreciation expense for 2020? Okay, so depreciation expense for 2020. If we now involve a fixed rate, uh, On January 1, 2019, London company purchased a large quantity of personal computers. The cost of these computers was 6 million. So we have now on the date of purchase, the management estimated that the computers would last approximately 4 years and would have a residual value at that time of 600,000. The entity used double declining balance method. During January 2020, the entity realized that technological advancements had made the computers virtually obsolete and that they would have to be replaced. The management changed the remaining useful life of the computers to 2 years. So that is only after 1 year. If the original life was 4 years and the remaining life is 2 years, but the depreciation recorded was only for 2019. So we now have the fixed rate of 100% divided by 4 years and multiply this by 2 years. So we have the depreciation uh, expense and the accumulated depreciation good for 50%. So based on 6 million, the depreciation for 2019 is 3 million. So the carrying amount on January 1, 2020 is only 3 million. And the residual value of 600,000 as given. So the difference of 2.4 million, that's the maximum depreciation in 2020. Now that's the remainder. But the fixed rate in 2020 is 100% divided by 2 times 2. So it's 100%. The problem is asking for the depreciation expense for 2020. This means that the computer should be fully depreciated in 2020 since there is a residual value of 600,000. The maximum depreciation for 2020 is equal to the carrying amount of 3 million minus the residual value of 600,000 or 2.4 million. Now, the remaining useful life of the computers was reduced to 2 years. So, this means that there will be a depreciation expense for 2020 that's equal to 2.4 million. Okay, so we have now problem 8-12, the last problem here. We have January 1, 2020, Canyon Company decided to decrease the estimated useful life of the patent from 10 years to 8 years. The patent was purchased on January 1, 2015 for 3 million with the estimated residual value of 0. The entity decided on January 1, 2020 to change the depreciation method from accelerated to straight line. January 1, 2020, the cost of the equipment is 8 million and the accumulated depreciation is 3.4 million. The remaining useful life of the equipment on January 1, 2020 is 10 years and the residual value is 200,000. What is the total charge against 2020 income as a result of the accounting changes? So we have now the patent on January 1, 2015 with the original cost of 3 million, then the accumulated amortization since the life of the patent was estimated to be 10 years. Now, as 10 years given above, so we have 300,000 a year multiplied by 5 years. That's on January 1, 2020 or December 31, 2019. So we have now the accumulated amortization of 1.5 million. So the carrying amount of the patent is 1,500,000. So the amortization of the patent for 2020 is only 500,000 because based on the carrying amount, the life was reduced to only 8 years from the original date of acquisition. So meaning the 8 years minus 5 years expired, you only have the remaining 3 years. So 1.5 million divided by 3 years or 500,000. Then the depreciation for 2020, we have 4.6 million. That's the remaining carrying amount of the equipment, 4.6 million, and that's 8 million minus 3.4 million is 4.6 million, and we divide it by, or we deduct first the residual value of 200,000. So we have 4,400,000 divided by 10 years, since as stated the cost of the equipment is 8 million, and the accumulated depreciation is 3.4 million, and the remaining useful life of the equipment is 10 years. So we divide 4,400,000 by 10 years or 440,000. The total charge against 2020 income is 940,000. So that's letter A. Then we go to the multiple choice problems. A change here. Let's begin with 8-13. A change in the periods benefited by a deferred cost because additional information has been obtained is an accounting change that should be reported in the period of change and future periods if the change affects both. Now, a change in the residual value of an asset arising because additional information has been obtained is an accounting change that should be reported in the period of change and future periods if the change affects both. Which statement is in relation to change in accounting estimate is true? Change in accounting estimate results from new information or new development. 4. The effect of a change in accounting policy that is inseparable from the effect of a change in accounting estimate should be reported as a component of income from continuing operations in the period of change and future periods if the change affects both. Number 5. When an entity change the expected service life of the asset because additional information has been obtained, which of the following should be reported? An accounting change that should be reported in the period of change and future periods if the change affects both. So we have now the answers to 8-14 and 8-15. Now take note of this letter answers. Okay, then we move on to chapter 9. Chapter 9, we have problems beginning with 9-1 up to 9-16, and we will just share screen the theory answers. So 9-1. Okay, so let's now move to chapter 9. Okay, so in 9-1, the question is, ignoring income tax, the accounting change should be reported in the current year. At the beginning of current year, Black Company changed the inventory cost flow method from 254 from LIFO for both financial statement and income tax reporting purposes. The change resulted in 600,000 increase in the beginning inventory. Now that's from LIFO to FIFO. Okay, so the answer is retained earnings statement as a 600,000 credit adjustment to the beginning balance. Since the change actually is an increase in the beginning inventory. So increase in the beginning inventory, meaning that was an increase in the ending inventory of the previous year. So if the ending inventory increase, meaning the cost of goods sold decreased, that should have increased the net profit for the period. So you have a credit to retained earnings. 9-2, during the current year, Orca Company decided to change from the FIFO method to the weighted average method. Inventory balances under each method were as follows. So in January 1 and December 31, the FIFO has inventory balance of 7.2 million, the weighted average of 7.7 million. On December 31, 54, 7.9 million, and weighted average of 8.3 million. What amount should be reported as a pre-tax effect of the accounting change in the statement of changes in equity for the current year? So the inventory January 1, 2020, that's the beginning inventory, with a weighted average balance of 7,700,000. With FIFO, it's only 7.2 million. So the effect of change increase in inventory because the company, as stated here, decided to change from the FIFO to the weighted average. So it means an increase in the inventory value, or we have the FIFO in January 1 and the weighted average of 7.7 million. So there is an increase in inventory of 500,000, which should be added. Now in 9-3, Goddard Company had used the FIFO method of inventory valuation since it began operations in 2017. The entity decided to change to the weighted average method for determining inventory cost at the beginning of 2020. So that is after 3 years. The entity provided the following year-end inventory balances under the FIFO and the weighted average methods. So we have now the years, then the amounts of inventory and under FIFO and under weighted average. What pre-tax amount should be reported in the 2020 statement of changes in equity as the cumulative effect of the change in accounting policy. So cumulative effect of the change in accounting policy. The inventory on December 31, 2019. So under the FIFO method, it's 8.3 million. Under the weighted average, it's only 7.8 million. So the company had used the FIFO and now it will shift to the weighted average method. So there's a decrease in inventory by 500,000. So the adjustment on January 1, 2020 to reflect the change in inventory method is debit to retained earnings and credit to inventory by the amount of 500,000. There is a decrease in inventory at the end of 2019. So if the inventory decrease, so meaning the what will happen if the inventory decrease, the cost of goods sold will increase, and so the net income will decrease. So the corresponding debit to retained earnings. Debit to retained earnings and credit to inventory. Now we go to problem 9-4. On January 1, 2020, Po Construction Company changed to the percentage of completion method from cost recovery method of income recognition. On December 31, 2019, the entity compiled data showing that income under the cost recovery method aggregated 7 million. So the net income aggregated 7 million. Okay? So we now have the if the percentage of completion method had been used, the accumulated income through December 31, 2019 would have been 9 million. The income tax rate is 30%. The cumulative effect of the accounting change should be reported in the 2020. So the cumulative effect of the accounting change should be reported in the 2020 retained earnings statement as a 1.4 million credit adjustment to the beginning balance. So we now have in problem 9-4 the percentage of completion, that's 9 million. The cost recovery method, it's 7 million. So we have now the cumulative effect under statement of income by 2 million. So the tax effect is the 600,000 under statement of income. Tax rate is 30%. So the net cumulative effect after the tax is 1.4 million. So in 9-4, retained earnings statement as a 1.4 million credit adjustment to the beginning balance. Next, we go to problem 9-5. In 9-5, we have a set of Bangko Construction Company has used the cost recovery method of accounting since it began operations in 2017. Uh, in 2020, for justifiable reasons, management decided to adopt the percentage of completion method. So initially, it used the cost recovery method, and now the percentage of completion method. The following schedule reporting income for the past 3 years has been prepared by the entity. So we have 2017, 18, and 19. The total revenue from completed contracts less cost of completed contracts. We have the income from operations. Then we have the casualty loss. Analysis of the accounting records disclose the following income by contracts uh, earned in the years 2017 to 2019 using the percentage of completion method. So we have in contracts 1, 2, and 3 for 2017. So that makes 2017 now with the total revenue earned for 2018 and for 2019. What pre-tax amount should be reported as a cumulative effect of change in accounting policy and the statement of retained earnings for 2020? So we now have in 9-5 under the percentage of completion method, we have the following income figures. So for 2017, percentage of completion method showed the income of 15 million, in 2018 16 million, and in 2019 for 9 million. So 2019 it's 7 million, I mean, because you have 8 million positive and 1 million loss from contract 5. Now for the cost recovery method, in 2017 we have income of 7 million, 2018 for 13 million, and for 2019 an amount of 12 million before the casualty loss. So the cumulative effect of the change from percentage of completion method, I mean from cost recovery method to percentage of completion, is a difference of 6 million. So that's now your cumulative effect. So what pre-tax amount should be reported as the cumulative effect of change in accounting policy and the statement of retained earnings for 2020? So in the statement of retained earnings for 2020. Next, we go to 9-6. In 9-6, how should this accounting change be reported in 2020? During 2020, build company changed from the cost recovery method to the percentage of completion method. So cost recovery to percentage of completion method. The tax rate is 30%. Gross profit figures are 2018, 19, and 20. So for the cost recovery method and from percentage of completion method, how should this accounting change be reported in 2020? So we have now the cumulative gross profit for 2018 and 19 are using the percentage of completion method. You are adding 1.6 and 1.9 million, so we get 3.5 million. Then for the cost recovery method, it's for a total of 2.2 million for 2018 and 2019. 2.2 million. So the cumulative increase you under the percentage of completion method is 1.3 million. So the tax effect is 390,000. So the addition to retained earnings on January 1, 2020 is 910,000. Now we go to problem 9-7. Problem 9-7. It's asking for what adjustment is required to retained earnings in January 1, 2020, and what amount of the development cost should be expensed in 2020. Now, Animos Company provided the following information at year end. So we have December 31, 2020 and December 31, 2019 with development cost and amortization. The capitalized development cost relate to a single project that commenced in 2017. It has now been discovered that one of the criteria for capitalization has never been met. So in question number 1 for 9-7, question number 1, what adjustment is required to restate retained earnings on January 1, 2020? So we have now development cost December 31, 2019, given is 5,840,000 and the amortization of 1.2 million. So we have the carrying amount. The entity committed an error in accounting for development cost. Thus, the carrying amount of 4,640,000 on December 31, 2019 is treated as a prior period error in the 20 statement of retained earnings. So we have prior period error in the statement of retained earnings. That's for the 2020 retained earnings. Then in question number 2, what amount of the development cost should be expensed in 2020? The remainder of the carrying amount of the development cost on December 31, 2020 should be expensed in that year. So we have the development cost of 8,160,000, and then we deduct the amortization of 1,800,000. The carrying amount on December 31, 2020 minus that in 2019. It's already given at 4,640,000. So we have now the remaining carrying amount of 1,720,000. So the answer is in 9-7, number 2 is letter C. Next, we go to 9-8. In 9-8, we are asked for the balance of retained earnings on December 31, 2020. While preparing the financial statements for 2020, the Kila company discovered computational errors in the 2018 and 19 depreciation expense. These errors resulted in overstatement of each year's income by 25,000 net of income tax. The net income for 2020 is correctly reported at 500,000. The following amounts were reported in the previously issued financial statements. So we have now retained earnings 2018 and the ending of 700,000. That becomes the beginning balance of 2019. So for the balance retained earnings on December 31, 2020, we first begin with retained earnings on January 1, 2020 is equal to 850,000. That's the beginning balance here. The ending of 2019 is the beginning of 2020. Then we have the prior period errors under depreciation. In 2018, there was an under depreciation of 25,000, resulting to overstatement of each year's income by 25,000. So we have a total of 50,000. The corrected beginning balance of retained earnings is 800,000. And then we add the net income for 2020 retained earnings, and 2020 is 1.3 million. Next, number 9. Effective January 1, 2020, King Company adopted the accounting policy of expensing advertising and promotion costs when incurred. Previously, advertising and promotion costs applicable to future periods were recorded in prepaid expenses. The entity can justify the change, which was made for both financial statement and income tax reporting purposes. The prepaid advertising and promotion cost totaled 600,000 on December 31, 2019. The income tax rate is 300,000. What is the adjustment for the effect of the change in accounting policy that should result in a net charge against income for 2020? So in number 9, the company committed an error of deferring advertising and promotion costs. A prior period error is not included in profit or loss but treated as adjustment to retained earnings. So the question is asking for the effect of the change in accounting policy that should result in net charge against income. There is none because the effect is as an adjustment to retained earnings. Then number 10, what amount should be reported as prior period error in the financial statements for 2020? So we have now during the year ended December 31, 2020, the following events occurred at Harbor Company. It was decided to write off 800,000 from inventory, which was over 2 years old as it was obsolete. Sales of 1 million had been omitted from the financial statements for the year ended December 31, 2019. What amount should be reported as prior period error in the financial statements for 2020? Now, it's the amount of sales of 1 million had been omitted from the financial statements. So this should be reported as a prior period error for 1 million. So actually, it's the 1 million sales that had been omitted. Then 9-11 In 9-11, we got two questions. What adjustment should be made to net income? In reviewing the draft financial statements for the year ended December 31, 2020, between company decided that market conditions were such that the provision for inventory obsolescence should be increased by 3 million. If the same basis of calculating inventory obsolescence had been applied on December 31, 2019, the provision would have been 1.8 million higher than the amount recognized in the statement of comprehensive income. What adjustment should be made to net income of 2020? Now, for 2020, the adjustment that should be made in number 11, question 1, the increase in the provision for inventory obsolescence on December 31, 2020 of 3 million is deducted from net income. What adjustment should be made to net income of 2019 presented as comparative figure in 2020? So the increase in the provision for inventory obsolescence is ignored because this is a change in accounting estimate and not a change in accounting policy. So in question number 2, the answer is 0. So we have letter D. Next in 9-12, in 9-12, question, what pre-tax adjustment is required to restate retained earnings on January 1, 2020? So we have now in number 12, the reduction in the carrying amount of inventory on December 31, 2019 of 280,000 is a prior period error in the 2020 retained earnings. This required a reduction in the carrying amount of inventory on that date equal to 280,000 in the statement of retained earnings, and the provision for uncollectible accounts receivable is a change in accounting estimate and therefore has no effect on retained earnings. So here only inventory. So we have letter A. In 9-13, after the issuance of the 2019 financial statements, Nara Company discovered a computational error of 150,000 in the calculation of the December 31, 2019 inventory. The error resulted in a 150,000 overstatement in the cost of goods sold for the year ended December 31, 2019. On October 2020, the entity paid the amount of 500,000 in settlement of litigation instituted against it during 2019. So in problem 9-13, problem 9-13, the adjustments are January 1, 2020 inventory with debit and credit to retained earnings. Then there is litigation loss which should also be credited to cash. However, this is a litigation loss in October 2020 the entity paid the amount of 500,000 in settlement of litigation instituted against it during 2019. In the 2020 financial statements, what is a pre-tax adjustment to retained earnings on January 1, 2020? So the corresponding entries 9-13, debit to inventory and credit to cost of sales, retained earnings, and debit to litigation loss for 500,000. So it does not affect the retained earnings account yet. So only 150,000 credit since our entries, a debit to inventory January 1, 150, and you first credit cost of sales, then second supposed to be, no, but anyway you can have a direct credit to retained earnings. Okay, so the 500,000 is still in October 2020, but on January 1, 2020, the adjustment is only for the inventory. In problem 9-14, uh, the company failed to accrue warranty cost of 100,000 on December 31, 2019. In addition, a change from straight line to accelerated depreciation made at the beginning of 2020 resulted in a cumulative effect of 60,000 to retained earnings. What pre-tax amount should be reported as prior period error in 2020? So in problem 9-14, only the unrecorded warranty cost of 100,000 on December 31, 2019 should be accounted for as prior period error. Change in depreciation method is a change in accounting estimate. Then we have now problem 9-15. In 9-15, in the December 31, 2020 financial statements, what amount should be reported as prior period error? So we have now the amount of number 15, the machine incorrectly expensed of 2.1 million, the unrecorded depreciation for 2017, 18, and 19. So that will be 2 million divided by 10 years. So 2 million divided by 10 years. And we have the residual value is 100,000. So that the depreciable cost, amo na ang nag 2 million na lang because we have to deduct the residual value from 2.1 million. So 2 million divided by the estimated life of 10 years. So 200,000 a year times 3 years for 600,000. The net overstatement of expense of 1.5 million. Tax effect of 450,000. So the net understatement of retained earnings. The fact that the machine was expense outright. So that overstated expense and understated net income and understated retained earnings. Now we have the corresponding entries. And we have 9-16, what amount should be reported as retained earnings on December 31, 2019. So we have now for retained earnings January 1, 2019 of 1.1 million. Then we add net income for 2019 for 600,000. And we have dividends declared and paid in 2019 for 300,000 given. So we have the retained earnings on December 31, 2019 of 1.4 million. How about retained earnings on December 31, 2020? January 1, you have 1.4, then add net income for 2020, a prior period error of in 2019 of 650,000 and dividends declared and paid. So we now have the prior period error in the amount of 650. No, retained earnings beginning 1.4, add net income 700,000, then prior period error deduct, and dividends declared. A prior period error, the amount of 650,000. This after tax effect of the error. Overstatement of net income for 2019 due to under depreciation. Okay, so we have now the answers to the multiple choice problems, theoretical 17, 18, and 19. Okay, so good night again. It's 11:20, and I hope you will study what you have heard, you have listened to. Okay.